Hi, everyone, and welcome to Bill Hampel's 2022 Economic Update, brought to you by American Share Insurance and Excess Share Insurance. Hi, my name is Dave Kettlehake, and I'm the VP of Sales and Marketing here at American Share. Before we get going, I've got a little housekeeping to go over. As we usually do, all lines are muted and all cameras are off. But if you'd like to ask a question, please do so in the Q&A box at the bottom of your screen. We'll do our best to answer those as we go, depending upon the number of questions we receive. We hope to get to everyone. If you'd like to resize any of the boxes on your screen, please click on the small square in the upper right-hand corner of that box, and it will resize for you. Also, a PDF copy of this presentation and some additional information about ASI and ESI are located in the resource list in the upper right-hand corner box. Just click on the resource and it will download to your computer automatically. We'll dive into Bill's presentation in just a moment, but before we do, I'd like to share just a little bit about our two companies. ASI has been in business for over 47 years, and just like credit unions offer a choice to their members, we offer a choice to credit unions. ASI offers greater coverage than federal share insurance because we insure up to $250,000 for each and every account of a member. Got a member with $5 million? Okay, open 20 different accounts and all $5 million will be insured. ASI is an insurer, not a regulator, and that is a really big deal. Our sole purpose is ensuring that your members' deposits are safe from loss. Lastly, ASI is a business partner. So instead of taking that one-size-fits-all approach or one-size-fits-none approach, we work with our credit unions and state regulators to develop flexible programs that focus on meeting the needs of your members. ASI provides primary share insurance for more than 1.3 million members in 10 states, and not one member has ever lost a penny in an ASI-insured credit union. Let's talk about ESI for a second. Excess share insurance, on the other hand, helps you build better coverage for your credit union and your members by protecting deposits from $250,000 up to $5 million over the NCUA's limit. Whether those accounts are large IRAs, money markets, business accounts, or public funds, ESI can help you protect these deposits and will work with you to determine the best coverage limits available. You've got the money in there now. You need that for when lending really kicks off in the future. So ESI helps you build better coverage for your credit union and your members. So let's get into the presentation. Just over 12 months ago, we hosted an update by Bill because at that time we were about a year into the pandemic. We asked him to share his insights into the economy then and what he thought might happen in the future. Last May, we brought you Carlos Molina and Derek Lasniak for the webinar Cyber Liability, a dynamic risk to manage. Ransomware, malware, and phishing attempts are all on the rise. They still are, and they cost credit unions millions of dollars every year. Then in September of last year, we asked Steve Rick, Chief Economist for CUNA Mutual Group and friend of Bill Hampel, to step in and give us his views on the state and direction of the economy at that time. All three of those webinars are still available for on-demand viewing. Just go to our American Share website and click on videos. But now let's focus on today. The economy on this 15th day of March is, shall we say, wildly different compared to last February. Inflation and oil prices are up, unemployment is down, the stock market is all over the place. I don't even know where it is today. And Russia's invasion of Ukraine has the entire world on edge. But what does this mean closer to home? How will that impact my members and my credit union? Bill Hampel is here today to help us figure some of this out. Many of you already know Bill, so no further introduction is needed. For those of you who may not, it's not a stretch to say you're in for a great hour of economic insight if those words actually all go together. Following a long and successful career as chief economist and chief policy officer for CUNA in Washington, D.C., Bill's now an economic consultant specializing in explaining trends in the economy and financial institutions. Besides his tenure at CUNA, he's held a number of positions while in the credit union space, including being on the board at Summit Credit Union, as a staff member at Navy Federal Credit Union, and as a board member with the National Cooperative Bank. Bill holds a doctorate in economics from Iowa State University. He and his wife, Diane, live in Tampa, Florida, where apparently he's become quite adept at the game of pickleball. Bill, thanks so much for being here to help us understand, as best as we can, the economy in these rather bizarre times.
Thanks a lot, Dave, and hello, everyone. I can't see you, but I'm pretty sure you all have smiling faces looking at your screens right now. And those are the screens that have this presentation on it, not your phones with your text messages and all that other stuff. I hadn't thought of this until Dave mentioned this, but this is the 15th of March, which reminds me of what Mrs. Caesar told Julius a little over 2,000 years ago, which was to beware the Ides of March. So I hope that's not a portent for us. But anyway, let's get into this. Also, on the title slide here, you'll see, in addition to my name, is my email address, mdbhampel@gmail.com. MDB stands for Mr. Dr. Bill. A friend of mine gave me that name a long time ago. If you have any other questions that we don't get to during the presentation, if you just want to shoot me an email, I'd be happy to respond to them in the next few days. My schedule's pretty light coming up for the next few days. So let's dive right in. Here's the agenda. First of all, I'm going to give you sort of a base economic outlook through 2023, which is sort of what the momentum in the economy had been building up for the last couple of years and where that would take us for the next couple of years. And then I'll talk about a few things that could mess this up or are going to have an influence on that outlook. The first one is the amount and duration of inflation. How high is it going to get and how long is it going to stay high, and when is it coming down and how much is it coming down? Well, maybe not answer all those things, but at least give you some food for thought on them. The amount and timing of interest rate increases. You know, the first one's pretty easy. It's tomorrow, 25 basis points. Got that one down. And then also what the war in Ukraine might mean for the U.S. economy. And then we'll talk about credit union impacts. So let's start out with the base forecast. This is CUNA's economic forecast that they put up on their website once a quarter. The way they develop this forecast is they get the CUNA's economist, CUNA Mutual's economist, Steve Rick, who Dave just mentioned, and me, and we all get together for a few hours on a Zoom call and basically talk through an economic forecast, and this is what we come up with, and then they put it on their website. So I'll give you this in summary first, and then I'll be talking for the next half hour or so about some variations on this theme. First of all, the format for these is all the same. So for GDP growth, we show that for the last 5 years it averaged 2%, which is it doesn't mean it was 2% every year over those 5 years. In 2020 was much weaker, and the other years it was more positive. But actually the long-term sustainable trend for the economy is between 2 and 2.5%. So that wasn't too far off. Last year was strong because it was a kickback recovery from the recession of the previous year. Was at 5.7%. We're forecasting GDP growth will slow down a bit this year to 4%, and next year a bit more, sort of touching down to its long-term sustainable growth rate of 2.8%. Inflation averaged 2.9% over the last 5 years. Actually, it was 2% or less for the first 4 of those, but last year, the just completed year being at 7%, brought that average way up. This forecast was made 2 months ago. You see January 12th up there in the left-hand corner. Was 3.5% for this year and 2.5% for next year. Right now, I would raise my forecast for inflation this year is 5 to 5.5%. However, next year I'm still at 2.5%. I think it's coming back down to 2.5% next year. We'll talk more of that later. Unemployment rate was 3.9% at the end of last year. It's already down to 3.8 now. We've got it down to 3.5 by the end of this year and staying next year. If you look at those first 3 numbers, that's basically an economy operating at full employment. Growth slows a little bit because we're at full employment, and you can't grow much faster if you're already at full employment. Fed funds rate is the target range is between 0 and 25 basis points. Now, tomorrow it's going to go up to 25 to 50. We had four bumps this year to 1.1%. We debated 4 or 5 increases. This again was 2 months ago, and we suggested that there will be 4 increases this year. We'll talk about what the futures market says about it in a minute, and then we're suggesting another 3 bumps next year, and both of those numbers, when we get to it a little bit later, I would revise up for you. The 10-year Treasury rate, got to be really, really careful here. Don't trust any economist's forecast of the 10-year Treasury rate, because the 10-year Treasury rate has been 200 to 300 basis points lower where Mother Nature thinks it should be for the last 15 years, based on everything else going on in the economy. And so we have always been over forecasting the 10-year Treasury rate. Perhaps now we're making an error this year and finally under forecasting it, because it's possible that it would exceed 2.5% by the end of the year, especially if the Fed's raising short-term rates more. And then the spread between those is just, of course, a difference. So the basic story here is that the macro economy has essentially recovered from the COVID recession. GDP is back to its pre-recession path, although the trail to get here has been a little bit up and down, especially as the Delta variant came in the third quarter of last year, was hit pretty hard. But we're basically back on path to be where the economy would have been had we not had the COVID recession. The labor market, as we saw in the previous slide, is approaching full employment. It's under 4% now, getting close to 3.5%. But the number of jobs still lags, and we'll talk about what that means in a few minutes too. So let's talk about gross domestic product for a few minutes. GDP. That's the measure of the total production of goods and services in the economy, the total amount of economic activity that's taking place. You'll notice, you probably have noticed when economists put slides up, we try to spend as much time on historical data, on looking backwards. The reason we do this, it's a lot easier to build a chart with actual data that you can pull out of someplace as opposed to having to make up a forecast. And it also it takes up time so that we don't have to be doing forecasting instead. And this one is a little different from normal in that I don't bring this up to the current. This is gross domestic product of 2019. This is through December, the fourth quarter of 2019, just before the recession hit, which began in March of 2020. And what this shows is monthly changes in GDP. Quarterly changes in GDP at annual rates. And notice on the left-hand side there, the scale, that's plus 10 to minus 10. That's plus 10% to minus 10%. And that's because the biggest quarterly increase we've had was almost 8% back in 2000. The biggest quarterly decrease we ever had was the fourth quarter of 2008 in the Great Recession of 08 and 09, which was just a little over 8% at an annual rate. And most of the other, it's really unusual to get a quarterly change in GDP of much more than 4%, and the negatives are, of course, unusual. The reason I show you this is I'm going to show you what happens now when I update this to the most recent available data, which is the fourth quarter of 2021. The quarter just ended. Notice, remember on the previous slide, how horrible the decline in GDP looked during the Great Recession. See, now we can hardly even see it here because of the huge decline in GDP. The GDP declined at an annualized rate of about 31% in the second quarter of 2020, and it recovered at about a 33% rate in the third quarter. These are annual rates. Of course, the recovery in the third quarter was less in absolute amount than in the second quarter's decline, because the 33% increase was on a base that was much smaller because of the decline in the second quarter. So this just shows you how remarkable this was. In fact, this recession here, the red bars here are red in any quarter during which at least 1 month was considered to be in recession. And that was March and April, the last month of the first quarter and the first month of the second quarter of last year. That recession lasted 2 months, and that is far and away the shortest recession ever on record. And they've been keeping track of this back to the 1860s. So this was a really remarkable change back then. So the one other way to look at this is I want to introduce you for a moment to one of my best friends. His name's Fred. In fact, he's a really good friend of almost all economists in the U.S. If you asked all economists, if you polled us, anonymously, that would help, to list the names of our top 5 friends, probably quite a few economists wouldn't be able to come up with 5 names, but of the names they came up with, Fred would probably be on most of the list. And the reason for this is that Fred stands for Federal Reserve Economic Data, and it's actually from the Federal Reserve Bank of St. Louis. And just about every publicly available data series that you can imagine is maintained by Fred, by the Federal Reserve of St. Louis, and they make this data really easily available. So I just pulled this off of their site a couple of days ago. You can download the data. I just actually downloaded this as a PowerPoint slide from their site. But if you look over here, what you see, let's see if I can draw something for you. There we go. We're about to do some sort of visual regression. If you run along this line here, just keep running along, we are now just about where we would have been had we not had a recession. So that shows how, despite this enormous plunge in economic outlook in the second quarter of 2020, the initial really strong recovery in the first quarter, and then basically much above average recovery since then, we're now back to where we would have been without the recession. And if you don't believe me, here's another way of looking at the same thing. The blue lines are the actual results, and in this case, these are not quarterly changes in GDP. There's an observation for each quarter on this slide, but what each bar shows you is the level of the rate of GDP during that quarter compared to what it was in the fourth quarter of 2019, which is the last quarter before the recession. So the economy was down 1%, 1.3% in the first quarter of 2020. If you add in the 8% decline, that's 33% annualized is 8% not annualized. If you add the 8% decline in the second quarter, you're down to 10% below the fourth quarter level of 2019. With a strong recovery in the third quarter, we're back up to minus 33. So what this shows us is that a year after the COVID recession hit, and this is in the second quarter, the first quarter of 2020, we were just barely almost back to the 2019 fourth quarter level. We were just above it in the second quarter at 0.9% of the 2019 fourth quarter level. And by the fourth quarter of last year, the latest quarter available, we were at 3.2% greater than we were in the fourth quarter of 2020. The green bars say, had the economy grown at a 2% annual rate over the period, which is sort of the bottom of the range of sustainable levels, which is fairly appropriate since the economy is essentially at full employment, then we would have been at 4.1%. So 3.2 and 4.1 to an economist are pretty close to each other, which means we are back to where we would have been had we not had a recession. And that,
Bill,
there we go.
Quick question came in. It kind of harks back to a few slides ago. Which causes the larger impact to the economy? The Fed tapering their treasury purchases or the rate increases to the Fed funds rate? What is the end result of this 1-2 punch to the economy?
Yeah. It's a really good question. They affect different sectors. The tapering, which I would call more like a cliff adjustment because it happened so fast. The Fed reducing its purchases of long-term bonds, and in fact, a few months from are likely switching to reducing the amount of long-term bonds that it holds by not repurchasing when existing securities mature. That affects longer-term interest rates, and therefore that affects those sectors of the economy that rely on longer-term interest rates. Think mortgage finance, think business investment spending. So it's differential sectors. The short-term interest rates, when the Fed raises the Fed funds target rate that flows through to short-term interest rates, affects a different different sectors of the economy. It's more like business inventory holdings and those sorts of things. And to be honest with you, it depends on how much the rates increase, and which sectors are most volatile at the time. I suspect that if there's similar size increases, and similar size increases, remember, implies a parallel shift of the yield curve. If there's similar size increases, I suspect that the longer term interest rate changes have a bigger effect on economic activity, on spending decisions and production decisions than do short term interest rates. But it's a really good question, and if I find an answer, it's David Warren. If you send me an email afterwards, I'll look into this, and if I get an answer, I'll send it to you later on. So the next thing we're talking about is employment and the labor market. These are the numbers that come out the first Friday of every month, and they come from the Bureau of Labor Statistics of the Labor Department. They're both in the same press release, but they're different sets of numbers. The first one is non-farm payrolls, and I don't know what they have against farm workers, but it's the total number of jobs in all places in the U.S. except on farms. And this comes from a survey of businesses, of establishments, of firms, of employers. And it covers a majority of the workforce, but tends to be larger firms, some small businesses, but it tends to be a higher concentration among larger businesses, larger employers. The unemployment rate, that's the number that's 3.8% now, is from a survey of households. They talk to workers instead of to employers, and it refers to the percent of the workforce that's working. So those are they come out together and they say similar stories, but slightly different ones, and we'll see why in just a minute. So here's non-farm payrolls, and again, we're stopping this in February of 2020. Why? Because the doo-doo hit the fan in March of 2020. So I wanted to show you what things were like up until COVID hit. We see the huge recession of 2009, when we lost 9 million jobs during the recession and its aftermath. And then since then, we've recovered 23 million jobs. Also, if you notice on the left-hand scale, thousands, that stands for thousands, of course. So the top of that scale is 600,000. The bottom of that scale is minus 1,000,000, which is minus a million. So during the winter of the Great Recession of 2008 and 9, fourth quarter of 8, first quarter of 9, we were losing about 700 to 800,000 jobs per month. So that was like the worst we've had. And then ever since then, when we started to recover in 2011 on, this increase in jobs since then has averaged about 185,000 per month. So for about 10 years, we were adding on average, not every month, the biggest month there looks like a little over 400,000. There were a couple with almost no gains, but the average was 185,000 a month. So here is wow, that's what happens when we build in the latest data up until February, up to last month, which came out Friday a week ago. The numbers on the left are all the same, but now if you notice the y-axis, the vertical axis, instead of that going up to 800,000 on the top and minus a million on the bottom, it's going up to 10 million on the top and minus 25 million on the bottom, because instead of losing 750,000 jobs a month for a few months in a row, which you can barely see on the left there under the arrow that says 9 million jobs lost, we lost 22 million jobs in 2 months. And so that kind of messes up the scale here. And also it's sort of just by coincidence, but in the entire period since the Great Recession up until the month before the COVID recession, we gained 23 million jobs. We lost all but one of them in the next 2 months. However, the recovery has been very sharp here, and we haven't recovered all of them, but we've recovered 20 million of those 22 million jobs since then. Just zooming in a little bit on the end of the last period of this. This is from January of 2020 through February of this year. We see there the 22 million jobs lost, and then the strong recovery of almost 2 million, and then almost 4 million in April and May, and then the recovery slowing down after that. But if you look just at the trailing 12 months, those bars there all look really small, don't they? But on those trailing 12 months, the average there is 556,000 per month, which is 3 times greater than the average job gain that we had during the 10 years running up to the COVID recession. Sorry. So you see, we have a really strong gains in employment over the last few years, and so analogous to the way I showed you the percentage of GDP compared to pre-recession GDP, this is the percentage of non-farm payrolls compared to the number of people working prior to the recession. And so this is as a percent of the December 2019 level. It got up to 100.5% in February because we were adding a few workers, fell a little bit in March to 99.5%, plummeted to 86% in April, and then recovered kind of smartly in the first few months. It's going gradually since then. It's back up to 99.1. So we almost have the same number of people working now as we did in December of 2019. Although, as you'll see in a minute, we should have a bit more than that because of some changes that have happened. The other way, this is the other source of that information. This is the unemployment rate. You know, the previous stuff was from the establishment survey of employers, the number of people they are employing. This is from households, or are you working or not? And this is the unemployment rate. Notice this goes back to 1980. Again, we look at the past, so I don't have to predict the future. The red shaded areas are periods of recession. And notice there's a recession there in 2020, the COVID recession. You can barely see it because it was so short. The unemployment rate tends to peak sometime after the end of the recession. This time it peaked the same month as the recession because the recession was so short, and it just skyrocketed and then plummeted. But actually, it's a little bit more complicated than that. The red line here is the actual reported unemployment rate. Let me flip back for just a second. The unemployment rate here was around 3.5% just before the recession, and the peak of that bar in April of 2020 from the COVID recession was around 14.5%. Notice that 14 there. So what I'm showing here is more recently, and that's the red line. It was 3.5% in January. It rose to 14.7% in April, and it's now down to 3.8%. That's the latest number we just got about 10 days ago. The problem with that number is that the way we report the unemployment rate is this: when they do the household survey, they ask a bunch of questions. And one of the questions is how many people in this household are over 16? And the number of people over 16 is the potential labor force. They don't cut it off at 65 or 70 or anything. It's anything 16 and over is the potential labor force. And then they ask how many people in the household are working. And then if that number is smaller than the number of people in the household, they say of the other people in the household, how many are actively seeking work? And if you are not working, but actively seeking work, and they got some questions to determine that, then you are considered unemployed. The labor force is the sum of those two numbers. It's everyone actually working plus everyone not working but seeking work. The rest of the people in the household, those over 16 years old and over who are neither working nor actively seeking work, are not considered part of the labor force. And so the labor force participation rate is the proportion of the total working age population, which is around 260 million, that is either working or actively seeking work, which is 150 something million. What happened was, when the recession hit, a whole bunch of people, when they were laid off because of COVID, were no longer actively seeking work because they didn't think there were any jobs available, they were told there weren't any jobs, or they didn't want to get sick, or their businesses were shut down. Excuse me. So the labor force participation rate plummeted by about 3 points. And that 18.9% that it says that the blue line is from a constant labor force participation. That assumes that if the labor force participation rate had stayed where it was before, which was about 63.5%, if it had stayed there, and all those people who dropped out of the labor force, instead of counting them as no longer in the labor force, we counted them as in the labor force but unemployed, the unemployment rate would actually have been 18.9%, which to an economist is 19. So the unemployment rate would have been 19. Since then, the labor force participation rate has recovered, although it's still about a point below what it was in February of 2020. So now, at the 3.8% unemployment rate is with still about 1% of the labor force that was previously in the labor force out of the labor force. If they were back in, the unemployment rate would be 5.3. So this just tells you, this is another view of, you know, at 3.8, it's like, whoa, we're right at full employment again. What this suggests is that there is still some available labor that just needs to be coaxed to get back into the labor force because a bunch of people have dropped out. Now, some of those people will never get back in because one of the problems with this labor force participation rate, it doesn't cut off at a retirement age because we don't know what retirement age is. And so some people over that period, baby boomers, have actually retired. So the actual, you know, effective unemployment rate is something less than 5.3 and something more than 3.8. I hope that's clear as mud.
Hey, Bill.
Yeah.
Real quick. So I had to read this twice to make sure I got it right. Actually, we have two. Another one just came in. Is the average hourly rate for the 20 million jobs gained greater or lesser than the job loss of 22 million back in the first quarter of 2020?
Yeah, I haven't seen actual data on this, but from other stuff I'm read, I'm pretty sure that the average hourly rate is higher for the new jobs than it was for the old jobs, for a bunch of reasons. Partly is some of the people who were slow to get back into the labor force did so because they were sick and tired of working at what they thought of as lousy jobs for lousy wages. And so they would tend to self-select and only go to jobs that were paying higher wages. The biggest labor shortages have been in those areas that tend to be lower paying, and that's where we've had most of the wage gain, the wage increases. So for the most part, this time, for those two reasons, I haven't looked at data on this, but I'm pretty sure if I did, we would find that the wages that people are getting when they come back to work are higher than the wages they were getting when. And was there another one?
Yep, you saw another one came in. Does the labor force participation rate include the impact of the baby boomer retirement?
I just answered that, and it doesn't. So again, this is from our friend Fred again. This I just pulled this off yesterday. This is how the labor force participation rate plummeted from almost 63.5%, got down to 60.4%, and it's now back up to 62.3%. And it won't get back up to 63.5% because, as I said a minute ago, baby boomers are considered part of the non-part of the working age population that are not working. So this leads to this puzzle, which is the stronger recovery in GDP than jobs. GDP is now above its pre-recession peak, but the labor market is still down to by 2 million jobs. And as I'm sure everyone's heard, there's another piece of information that the Labor Department releases every month is called JOLTS, Job Openings and Labor Turnover. Job openings, there are 11 million job openings right now. And if there are 11 million job openings, we still have 2 million people, fewer people working than a couple of years ago, plus the fact that the growth in the labor force, had we had in the normal participation rate, is about another 2 million people. So we should have 4 million people more working now than we did 2 years ago, had we not had COVID. But we have 11 million jobs, so there's still this excess demand for labor. There have been a number of factors limiting labor supply. The first of all was for about 4 or 5 months during each of 2020 and 21, there was elevated unemployment compensation as part of the COVID stimulus packages, but that's now been over for like 6-7 months, so that's no longer an issue. The second one is really a big issue and is just now beginning to fade, and that's unreliable school opening and the shortage of daycare. When parents couldn't rely on their schools staying open, when it was like week to week in some areas, if a school would shut down or a class within that school would shut down for a few weeks, it was a lot harder for both parents to work in dual parent households. Not surprisingly, of course, this tended to have a greater effect on female labor force participation than male, not totally, but more so for females than males. This should be ameliorating now going forward. Similarly, for employees' concerns about COVID, early on it was not just employees' concerns, but it was shutdown saying that you couldn't go to work, you weren't allowed to go to work. Now people can go to work, but still employees' concerns about COVID-19 and also customers' concerns about COVID-19 at consumer-facing businesses kept business down and kept labor demand and labor supply down for the employees' concerns. With a much higher level of vaccinations and the new things we're getting on new variants, talk about in a minute, that should be fading also. And then also, quite a few people are reassessing their careers. The COVID, the loss of the job and the change in the way we work had a lot of people thinking, if I'm not going to have a job for 6 months or 12 months, I'm going to go try to do something else. I'm going to go get some additional training or try something else. And therefore, those folks are retooling themselves for future better employment, and therefore they're not available in the labor market now. Some of that's going on too. The shortage of labor is really tough on small businesses, and I'm sure it's tough on a lot of you guys as credit unions. The Small Business Association reports that for several months now, about 50% of small businesses say they have unfilled jobs, that they can't fill all the jobs they have, which makes life difficult in the short run. In the long term, from an economic point of view, this could have a benefit because it will force businesses to do capital substitution, to substitute capital for labor wherever possible, to automate more, to digitize more, to do those sorts of things. That will lead to greater labor productivity and higher wages in the future and higher profits for those businesses too. So, but these are the reasons, but the point I'd like to make here is that most of this reduction in the supply of labor is due to COVID and COVID-related issues, and as COVID fades, those issues should fade too. Speaking of COVID, COVID has been episodic, each wave having a reduced impact. The future depends on both the transmissibility and the virulence of the new variant. I can never say virulence. See, I couldn't say it the second time properly. So transmissibility is how contagious it is, and virulence is how seriously sick you get when you get it. I'm not an epidemiologist, but from what I read, we're likely transitioning from a pandemic to an endemic state. And in an endemic state, we basically have it for indefinitely for quite a long time, but at a lower impact rate, and it's something we just learned to live with. Because of this, the macroeconomic impacts of COVID-19 should wane, and they already have, and they should continue to wane. If there is a new virulent variant, that's tough too, coming up sometime this year, all bets are off. If we have another variant, more like Delta than Omicron, that kills a lot of people when it starts, this will all, it will mess things up big time. But assuming that doesn't happen, the effects of COVID-19 should wane. There will be some longer-term effects. I think the fact that people had to work from home was really educational, and mostly to supervisors of an age in the upper half of the age distribution of the working age population, who didn't think that you could trust people to work at home, and found out that actually people do get a lot done when they're working at home. So work at home is going to be much more available than it was in the past. This will change all sorts of things about commercial building and office building and those sorts of things. Wage structures and income inequality, it could slightly push up lower income wages compared to higher income wages. We've already seen the speed up of digitization, and we found that face-to-face experience for kids in education is really important, but also there are some benefits from online education. We may end up with some hybrid of those two things.
Hey, Bill.
Yeah.
Real quick, and I'm not sure which direction Chris is going with this, but have you analyzed the impact of what's going on in China right now?
No, I haven't, and I could sort of surmise a few things, but it would take me a while, and so I'll just pass as saying I don't know enough about that to say anything that might be useful to you on it. Sorry. Here's COVID cases, and what we see here is the blue line, which is the number of cases, number of confirmed cases measured on the left-hand side, and the red line is the number of deaths measured on the right-hand scale, and these are daily numbers, 7-day moving averages, because they bounce around from day to day, and weekends they don't report and stuff like that. And in general, what we notice here is that the number of cases has been, with each new variant, each new round, except Delta was about equal, the number of cases has gone up a lot, but the death rate compared to the number of cases has come way down. This is partly because we've gotten new techniques and methods to treat COVID. It's also because the latest variants have not been nearly as virulent, there's that word again, as the previous ones. And in particular, you notice that, we were having 800,000 cases a day of the Omicron, but the death rate still stayed below where it was in the winter of a year ago. And actually, the number of cases was much higher than that with self-testing. People weren't going and getting the other tests. So this all suggests, this is further evidence that we may indeed be moving toward an endemic condition. Let me just flip back to this a minute. The flu that we all so aware of, and most of us get annual flu vaccinations. The death rate from flu on a monthly basis, on a daily basis, is around 800. It tends to concentrate in the winter months. But if the death rate, the current death rate from coronavirus at around 1,200 a day is not that much higher than what we have become used to over the last several decades in flu. And so if the coronavirus death rate falls a bit more, it'll be like another version of the flu. It's not nice to have two versions, but it's still not as bad as it has been. Yeah.
Hey, Bill, there's a question here, and I think it's actually a really good spot to have this. Do you see, and I've actually been wondering, do you see issues coming with all of the big buildings staying vacant due to employees working remotely?
Yes, I do. It's going to take several years for office space capacity to be absorbed by growth in the labor force when that labor force doesn't all need to be in the office at the same time. This is going to require changes in how we do work. If everybody is going to go in 2 days a week, but everyone's going to have their own office space when they go in, that doesn't change anything. But if we find a way that if everyone goes in 2 days a week and shares space with other people, we will have and continue to have an excess supply of office space for quite some time. These are two measures of consumer confidence and sentiment. I put it in here because this is sort of how COVID affects the economy right now. Is if COVID continues to abate and become less of an issue, consumer sentiment will improve. What we see here is how these are two measures. The blue one is the Conference Board's consumer confidence measure. The red one is the University of Michigan's consumer sentiment measure. They're slightly different, but similar enough for us for government work. Notice how they both plummeted in early 2020 as a result of the COVID hitting, and then they bounced around quite a bit after that, and started to recover first half of last year, came back down when Delta hit, and has been sort of flat since then. I expect these will continue to move upward to continue to recover over the next several months, unless we get a much greater expansion of what's going on in Ukraine or another variant of COVID. So Fiscal policy, that's the federal government's taxing and spending. We had two huge stimulus packages, one in 2020 and the other one in 2021, to keep COVID from crippling the economy. Those effects are essentially over. There's a little bit left, but they're almost all done. The infrastructure bill that was signed back in November amounts to about $550 billion in additional spending, which is peanuts compared to the $2 and $3 billion stimulus packages we had earlier. The Build Back Better, President Biden's Build Back Better proposal future is uncertain, and I think that's putting it charitably. But it would also be largely, quote, paid for. In other words, it wouldn't increase the deficit. It would be paid for by increased taxes and fees, which is one of the reasons it's not likely to pass, very much of it, because no one wants to pass new taxes and fees. We still have the two underlying twin problems. This is a longer-term issue, Social Security and Medicare. And with baby boomers retiring, this is going to make things worse. But Congress is pretty good about pointing off things that aren't problems next week. And so, unfortunately, they're not going to address Social Security and Medicare for a while, which they should have done several years ago. The net effect of fiscal policies that the stimulus is over for now. A big part of the recovery of the economy over the last 2 years was because of fiscal stimulus, and that is going away. But the economy has enough momentum on its own to not need it anymore. The fiscal policy, you can sort of measure it by the size of the federal deficit. If government spending is bigger than taxes, they're putting that much more into the economy than they're taking out. In the 2 years prior to COVID, the government's deficit was running, this is like in 18 and 19, was running at just under $1 trillion a year. In 2020, that bumped up to $3 trillion. Last year, it was down to $2 trillion. So those, three's bigger than one and two's bigger than one. So that's the amount of the excess fiscal stimulus. This year, the federal government's deficit is likely to be around just a little bit over $1 billion, which would be back to its 2019 level. And next year, it's going to be coming in at about $800 billion. So it's actually falling. So this actually will be called fiscal drag when you're reducing the size of the deficit. Inflation. Okay, here we go. This is the Consumer Price Index since 2010, and these are 12-month moving averages. And it's monthly data, but it's each month looks back for the previous 12 months, and the latest numbers we have that just came out recently are February. And in February, the top line of the Consumer Price Index, looking back a year, was 7.9%. The core was about 6.3%. That's the blue. The core is everything in the top line except food and energy. And the reason we take out food and energy is that they are incredibly volatile, and they often go way up and they often go way down. And in fact, if you look over the last 10 years, you'll notice that the all items sometimes is way above the core and at other times is way below the core, but averaged over that's actually 11 years from 2010 to 2020, could include both endpoints. If you count it out on your fingers, you'll see that that's 11 years. The average of the all items was 1.7 and the average of the core was 1.8, which means that over those 10 years, food and energy prices went up just slightly less on average than everything else, for the all items to be slightly below the core. So that's the history. So we had this period of really low, the Fed was always almost worried about inflation being too low, but inflation has picked up and is way above what the Fed wants it to be now. So what's the deal here? Is this something temporary or long-lasting, or in fact, the term that the Fed was using up until a few months ago, was transitory. They're not using that T word. They're not using anymore, but temporary is another word that we could be using. So I'll give you my view. I think that the run-up of inflation we've had is largely temporary. It is going to stay high for a while, but in another year or two from now, it's going to be back close to where it was 2 or 3 years ago. And here's why. There are a number of temporary factors. The reason we had this bout of inflation is how we in the economy and consumers and everything responded to COVID. It's what COVID did to the economy caused inflation. If indeed COVID is retracing, if COVID, the effects of COVID are going away, the inflation-inducing effects of COVID will be going away also, and that will take away the impetus for inflation. Here they are. First of all, when COVID first hit, bang, we shut down the economy. Remember that minus 33% drop as an annual rate in GDP in the second quarter. People just quit spending money, quit doing anything, stayed home, didn't go to restaurants. All of that stuff stopped. It's very easy for consumers to quit spending. And demand can respond much faster than supply. And so a year or so later, now when the demand comes back and people want to go and spend, it's a lot harder for supply to recover as fast as spending. Businesses, it's a lot easier to shut down a business than it is to start a business. It takes more time to shut down a business. If your demand totally disappears in a matter of a few weeks for many businesses, they have to close if there's a total elimination of demand. If a business needs to start up, it takes a lot more than a few weeks. So that's part of the reason that supply has been slower than demand to recover, which has pushed up prices. We've got this huge pent-up demand right now from the involuntary savings buildup. The involuntary meaning people couldn't spend the way they used to before COVID, and so they just couldn't spend all their money, even with Amazon. And so they ended up building up more savings. So I've seen estimates of around $2 trillion of additional savings accumulation in households over the last 2 years, above what they otherwise would have done. The 70-20 rule applies here, by the way. I've seen an estimate that about 70% of that excess savings is held by households in the top 20% of the income distribution. So it's not evenly across the income distribution. Supply chain bottlenecks, when COVID happens, if some businesses and supply chains get stopped, that screws up the supply chains. Over the last 2 or 3 decades, we have developed an incredibly efficient but fragile supply chain system, sort of built, supporting the notion of just-in-time inventory management. Don't waste money on having an inventory of inputs you need for production. Order them to arrive just before you need them, so you don't have to spend any time, effort, or resources on storing them someplace. Just put them right into the production process. That works great until the supply chain gets messed up, and then your whole production process gets messed up, and that feeds through the system. Labor supply curtailment, we talked about that a little while ago, why the labor supply has been reduced. I think that the causes of that reduction in the labor supply will be reducing over the rest of the year. And then, as I said a minute ago, this hugely stimulative fiscal policy is winding down. There is, however, a long-term threat, and that is if inflation expectations become entrenched. And in fact, with the way the media is covering inflation right now, one might almost think that it has been entrenched. But it's sort of like Mayday, Mayday, Mayday. We've got 8% inflation. But I think that's temporary. I'll show you in a minute. If loose monetary policy overshoots, they already reduced their quantitative easing a few months ago, and they're already about to raise interest rates tomorrow. Many argue with some support that they maybe should have started that 6 to 9 months ago, but they are starting now, and they're likely to do it fairly aggressively. What is true here is that it's going to take longer than some of us thought for this inflation to be wound out. So here's the question that I get from quite a few folks. But aren't we on the path to the 1970s style inflation, and it's just horrible effects? And the reason for that is, last week when the new inflation numbers came out, they said it was the highest inflation rate in 40 years. If you subtract 40 from 2022, that's 1982, and that was follow-on in the 1970s. So that pulls us back to, oh crap, we're back to where we were in the 1970s. And I suspect that most people on this webinar, who might still be on it, were, if anything, in middle school or not even there yet, the last time we had big inflation in the 1970s. So you may not remember what it's like, but high inflation is horrible. It transfers wealth from creditors to debtors. If I owe money, I like inflation because the purchasing power of the debt I owe falls each month. Conversely, if I am owed money, the debt The loan that I own gets less and less valuable each year, each month because of rising inflation. It hurts those on fixed incomes because prices are going up, their incomes aren't. And this, to economists, is the worst part. It obscures the signals of relative price movements. You all remember from your econ classes in college that the teaching of econ is broken into two halves: macroeconomics, which is what we've been talking about, GDP and all that stuff, and microeconomics, which is individual goods and services and relative prices, and how relative prices are these wonderful signals, the invisible hand of Adam Smith, that get resources allocated, and so that we always produce stuff in the right quantity and the right amount, and price signals tell consumers and producers when and how much to consume and produce to make things work. That's why, to us economists, inflation is really yucky, because it messes up the effectiveness of those signals, of those changing price signals, because inflation is causing some of the change. It also causes hoarding. If people think prices are going to go up, they go out and hoard, and that creates more shortages, which makes things even worse. Think of toilet paper 2 years ago. And in the extreme, social unrest. Look at a really strong case could be made that the Nazis could not have come to power in Germany in the 1930s had Germany not had the hyperinflation that it had at the time. And we're not talking about anything like that now, but high inflation makes people disgruntled, and disgruntled people do crazy stuff. And in today's internet and social media driven world, that the amount of disgruntlement that happens as a result of causes that are reasonable for people to get upset about is magnified tremendously. So that's something could happen here. The other thing is that reducing inflation is very costly. We had two really big recessions in the early 1980s, 80 and 82, to bring down the inflation, and those were the worst recessions since the 1930s. But here's why I think it's different now. First of all, the short-term supply, the inflation we're having right now is from short-term supply and demand disruptions, primarily driven by COVID, as opposed to a long-term demand buildup. The inflation is not yet embedded, but the memories of the cost, the things I have listed at the top of the slide, people are screaming about inflation now, which puts political pressure on the Fed and others to take fairly aggressive actions to stop it. So here again is the picture of inflation, and notice that in the last year, it's gone from around 2% up to 7%. Here we see something from my friend Fred again, and this is the same number. This is the 12-month trailing consumer price index inflation rate going back to the 1960s. And the big difference is here is that the inflation rate that we had recently has spiked up to this 7% in less than a year. This is temporary so far. The inflation buildup that we had in the 70s actually started in the mid-1960s. In June of 64, we were down around 2%. We had a big run up till 69, then it came back down a bit. A huge run up till 74, came back down again. Another big run up to over 14% in the middle of 1980, and that's when Paul Volcker stepped in and put interest rates through the roof, and we had the horrible recessions that cured inflation. That took 16 years to build up. We're in a year now. If the inflation we have now lasts for another couple of years, we're in deep kimchi. But if it comes down in the second half of this year from both reduction in the effects of COVID and rising interest rates on the part of the Fed, I don't think then in a year or two inflation will be back down. This is just a picture of oil prices. When you get when you download the handout, you can look at it. When oil price, that picture says when oil prices go way up fast, they tend to come way down fast, not long after that. Yeah, Dave, another question?
Actually, we have apparently inflation is a really big concern with everybody. We have a lot of questions that came in about this. Being cognizant of everybody's time, I don't think we can answer all of these at this time. Bill, would you be okay with staying on at the end? We can hit a couple, and then
Sure.
those that you don't hit, then you might be able to do individually afterwards. You okay with that?
Sure. Yeah. Let me get through the credit union impacts, and then I'll be happy to stay on and talk about inflation afterwards for any questions that people have.
Okay. Thanks.
Okay, so here's interest rates. Here's what's happened. Going back to '88, the Fed funds rate has been at 0 or 10 basis points. The target range here is 25 basis points for a couple of years now. The 10-year Treasury really bottomed out when COVID hit and has recovered. These are monthly numbers. Here's a more recent version of the same picture. The 10-year Treasury is, on a monthly average, is bumping against 2%. This morning it was 2.12. So, you know, if it stays up there, we're above 2 now. And this is based on what the Fed's likely to do. Here's some yield curves. The red line is back in November of 2018. That was sort of the peak of the interest rate cycle before things slowed down, before the economy began to slow a little bit going into 2019 and 2020. The green line is right after COVID hit, when all interest rates were basically about as low as you can get. The 10-year Treasury was at like 60 basis points, which is crazy. And then the black line is February. Is that black or navy blue? Whichever one. That's last month. The average for last month, and short rates are starting to rise. Long rates have already risen, and that yield curve right today would be even a little bit higher than that. So what's going on here is monetary policy. There we go. Federal Reserve's monetary policy. They began to taper their quantitative easing by $15 billion in December, and then in November, and then $30 billion in December to end in March. And they're doing the last one in March, so that they will have their last increase in their holdings of long-term treasuries and mortgage-backed securities in this month. A few months from now, as I said before, they're likely to start quantitative tightening, which is letting their huge balance sheet start to shrink back down a bit. That will put upward pressure on longer-term interest rates. Tomorrow, the Fed will raise the Fed funds overnight rate by 25 basis points. That's kind of, you know, locked in concrete by now. And if you look at the futures market, which I'm sure many of you do, by the end of the year, the futures market now, it says most of the probability is that we will have 7 25 basis point rate increases by the end of the year, 6 more after tomorrow. And, you know, this could be 25 at a time, or it could be, 50 basis points one meeting and then not the rest. I'm pretty confident by the end of the year that the Fed funds rate will be somewhere between 1.25% and 1.75%. It really depends on what happens to inflation. The faster inflation comes back down, the less of an increase in Fed funds rate we get. The more persistent inflation is, the more the Fed's going to have to continue to react. Now, the impact of the war in Ukraine. Actually, the short answer is, for the U.S. economy, the impact will not be that severe, so long as the fighting is restricted to Ukraine itself. What the effect of the war, the fighting in Ukraine, will keep oil prices a bit higher than they would have been because of sanctions on Russian oil. Other commodity prices will be elevated because Russia is a commodity-based economy. The European economy will be affected by the war there, and therefore there'll be less spending from European countries, which will be a reduction in our exports to Europe. And financial markets will stay jittery because, the wars or financial markets like to know the future, and wars create uncertainty, and financial markets therefore get upset, like the stock market I'm thinking here. If the fighting does spread to other European countries, i.e. NATO countries, things will get much worse. All bets are off, and there will be much more substantial disruptions. And I think that's really, really unlikely. And if it does happen, I just know it'll be bad. Specifically, I don't know which part of bad. Okay, that's 10 minutes on credit union impacts. Here's the same sort of format from before. This is CUNA's credit union forecast. If you just look at the last 3 columns, savings growth last year was 12.5%. We have it at 5% this year and next year. Loan growth was a little over 7.5%. We have it at 9% this year and next year. Asset growth just comes from deposit growth. Membership growth has been quite strong. We think it's going to stay pretty high at 4% this year and next year. Loan to savings ratio is just calculated from savings and loan growth. A few years ago it was 86%. At the end of last year, it's 71%. With the slowdown in deposit growth and the strengthening of loan growth, the loan savings ratio should be drifting up to 73% at the end of this year, 76% at the end of next year. The delinquency rate, which is ridiculously low at the end of last year, will start rising. We got it to 0.6% and 0.7% next year. Net charge-offs also incredibly low at 0.25% of loans last year. We've got that coming up to about 40 basis points this year and 45 next year. The long-term average for this is about 50 basis points for the last 25 years. So we're just getting back to that normal. ROA last year was fantastic, given everything that was going on at 107. For reasons I'll tell you in a minute, I think it's going to be under quite a bit of negative pressure this year, not catastrophic, but down to 70 basis points this year and maybe inching back up to 80 basis points next year. Given these earnings rates and the slower savings growth we have, the capital ratio would, if this all happened, would drift upward a little bit this year and next year. Earnings not as strong, but asset growth driven by deposit growth even weaker. Okay, so here's some, the basic story here is that our members are in pretty good shape right now. The last couple of years have been good for household finances. The unemployment and job losses that happened were fairly short term. Most people who wanted to get back to work could get back to work pretty quickly, except for some consumer facing sectors. Unemployment compensation buffered a lot of people from also rental evictions and foreclosure. In fact, you couldn't foreclose, helped households' finances getting in really bad trouble. The forced savings we talked about a little while ago strengthened balance sheets. What strengthened balance sheets even more than that was that housing, instead of falling in value like last time, rose, and the stock market has also done very well. This does give us sort of a K-shaped recovery, because if you had a house or money in the stock market, you've done really, really well. If you didn't own a house or have money in the stock market, you didn't have that advantage. What this slide shows you is on the left is what happened to the S&P 500 in the 23 months following the beginning of the recession, the Great Recession in 2007, down 27%. The one on the right says in the same period following this recession, even with the decline we've seen in the last few months, the stock market is still up 36% from where it was. Similarly, for home prices, in the last recession, home prices were falling as the recession, it started falling before and continued falling. This time, home prices are up 31% in the 22 months since the beginning of the recession, since just before the recession, sorry. So household balance sheets were not nearly affected like they were last time. So what's this mean for credit unions? We've got loan growth exceeding deposit growth for a while, so you can restore a bit of liquidity. We've got the slight rise in delinquency and loan losses. I showed you that a minute ago. Below normal earnings. So rising interest rates are going to have differential effects on net interest margin, and by that I mean differential by the credit union. Rising interest rates are going to cause some credit unions to have an increase in net interest income, and the reverse for other credit unions. And it just depends on how asset sensitive you are. Which side of your balance sheet is more sensitive to changes in interest rates. And let me tell you that this time it is, I think, incredibly difficult to parse out what's likely to happen here. I'll just give you a couple things I'm concerned about. And, usually I'm Pollyanna about these things and say, don't worry about things, it'll all work out fine. But I'm a little concerned here. One of my concerns is that a significant portion, about 2/3 of the mortgage loans the credit unions have, are fixed rate 15 and 30-year mortgages when they were made. And they were likely, many of them made at interest rates lower than what rates are going to be for the next couple of years. And so they're not likely to prepay very fast, other than for people moving. The refi effect of prepaying is not going to be there anymore. So if you look back at the typical length of time that you had a mortgage on your books over the last 10 years, over the next 10 years, it might be quite a bit longer, which isn't good if interest rates are rising. The other issue on the other side of the balance sheet is about 75% of credit union deposits are in what we call non-maturity shares, non-maturity deposits. That's share drafts, checking accounts, regular savings, and money market accounts. And I think non-maturity is a correct term because it means there's no specific maturity date, but the other way we might describe those is instantly maturing deposits. In other words, the members can take the money out whenever they want to, and so if they find a more attractive place someplace, interest rate someplace else, they could take the money and go there, and therefore credit unions might have to do fairly significant increases in interest rates. This is particularly true for the significant chunk of money that is in money market deposit accounts. And where I'm concerned here is with money market interest rates rising over this year and next year by between 1.5% and 2%. Let's just be general. These old-fashioned things called money market mutual funds, which the competition from which is why we invented money market deposit accounts 30 years ago, are going to become quite attractive, and credit unions may need to be very competitive on those rates to keep the money. It also depends on your local competitive market. The one thing that I do think the credit unions could do is that the portion of their non-maturity or their instant maturity deposits that is in checking accounts, as market interest rates rise, I would be really careful about raising those at all. The benefits and the value that a member gets from a checking account is not really the interest they earn on that, it's all the other stuff that goes with it. And since there's quite a bit of inertia there in those accounts. So I would, if you're thinking about how to react to changes in interest rates, I would think about not changing all of those rates across the board, being really differential about the, segment those types of deposits and only raise the rates that you have to based on what's happening on the asset side of your balance sheet. The other bad news is overdraft revenue is going to be down, and mortgage origination income, gain on sale of mortgages are going to be down because mortgage rates are already up by 50, 60, 70 basis points. And so the refi volume, some people might be trying to refi this to beat the final big increase in interest rates, but the refi volume is over for now. Unless, of course, COVID hits in the second half of the year and rates come back, 10-year goes back down below 1%. I don't think that's going to happen. And as you all know, that overdraft revenue is under increasing pressure because of large banks announcing that they are reducing overdraft fees, even if some of those announcements might be somewhat disingenuous. One good piece is that interchange revenues should hold up on your credit cards. Bad news is operating expenses are due to recover. They've come down a bunch in the last couple of years with rising labor costs. You're going to see an increase in operating expenses. And then the loan loss provision boost is ending. Most credit unions, on bulk, on average, credit unions over-provided their allowance accounts as COVID hit, thinking that we're going to have big increases in loan losses. Didn't. So your allowances were overfunded, and so you've been able to draw that down a bit, but that's about done. And this gives us our stable net worth ratios. And I think I just have one or, this is on new and used vehicle sales. It's hard to get data on used vehicle sales, but I found a source, and it's about 40 million a year in used vehicle sales and about 15 million a year in new vehicle sales. And so what happens and you guys have more of your funding in used than new, and this is probably why. What this shows is that this is annual data up until 2020 and then monthly data since then, and we see that in the latter part of last year, everyone's running out of cars to sell, which is going to hurt, of course, loan volume for credit unions. I think that by the second half of this year, the chip shortages will begin to be reduced, and we'll start getting a pickup in volume of auto sales, which will make it easier. And then the other thing is mortgage interest rates. This is just to show you, of course, that I wasn't making this up. This is the 30-year fixed rate mortgage rate, and it was, down around 2.75% a couple of years ago, and it's back up now a full percentage point higher than that. So here finally is what credit union earnings were for the last couple of years, the last 3 years, and then the arrows are my guesses about what my estimates of what's going to happen this year. Your yield on assets is going to go up, so is your cost of funds. That's the question marks. For some of you, the net interest income will rise. For others of you, it might fall. Operating expenses, the red lines are bad for the bottom line. The green ones are good. And notice there are more reds than greens. Operating expenses are going to go up. Non-interest income is going to fall. And provisions are going to rise a bit. Like that 6 basis points of provision expense last year is like crazy. And that means ROA is under negative pressure. Luckily, most of you are well capitalized, and a year or so of softer, but still okay net income isn't going to break the credit union. So that's my last slide. Again, I'm going to stick around now for any other questions that come on. The rest of you, if you want to get off, that's great. I'm sure you have much more useful things to do, and I think David has something to say.
Hey, Bill, real quick, and everybody, first of all, thanks for being here today. We do have a hard stop at 3:30 Eastern time because that's when the platform will cut us off. So we've got about 13 minutes left for Bill to answer additional questions that we've got in here. If you want any of your peers to see this webinar, it will be on demand in about an hour through the same registration link you had before. And please reach out to me or Bill Hampel. You have his information from the beginning of the session. You've got his email addresses, plural, to get a hold of him as well. So, Bill, you've heard of speed dating. Let's go with speed answering, if we can here. Okay. First, do you think we could end up with an inverted yield curve in the next year or two? Go.
Unlikely. The quantitative, the strength of the economy, the inverted yield curve would precede a recession, and so that would require the economy weakening toward a recession. That we get an inverted yield curve if inflation is so persistent that the Fed has to keep raising interest rates so much that not only does that reduce inflation, it also slows the economy. What we're shooting for is a soft landing, where we slow economic activity a little bit, but not so much that we cause a recession. So that's the same question is, are we going to have a recession in the next couple of years? We could, but I would not bet on it. I think it's unlikely.
What impact, if any, do you think the midterm elections will have on, the question was on these numbers, and I believe it was either in your inflation slides or right before that.
Yeah, so very little. The elections have much, in the short term especially, have much less of an effect on the economy than the media would like us to believe. You know, they need to get your eyeballs coming back every night, and so they'll talk about the effects on the economy. I think that they're fairly mild, especially what we have as a midterm here is congressional elections, which are likely to break the, right now the Democrats have control of the House and sort of control of the Senate. After the midterm elections, the Republicans are likely to have control of both of them, or at least the Democrats' majorities, slim majorities, will be even slimmer, which means that there won't be anything serious coming out of Washington. And so there won't be, in terms of the macroeconomic effects, it means that we're sort of stuck now with fiscal policy being behind us, and we're not going to get any new fiscal policy. The midterm elections will just solidify that view.
How long do prices have to remain inflated before they become the norm, and any reduction runs a risk of deflation?
Yeah, I don't think we would get deflation as a reaction to it. Once it's embedded, it's harder to get down, and you don't get deflation as a result. What you get is a recession as a result. So if inflation stays too high for too long and gets embedded in expectations, that means it will take coming back to the previous answer, it's fairly consistent. It will take a recession in order to stop that inflation. It will take an increase in interest rates strong enough to invert the yield curve to fight the inflation, which would cause the recession. So the question is, how high do they have to go? And it's not just high; it's for how long they have to be there. And so if inflation stays at this level for the rest of the year, I start getting really concerned. If inflation doesn't peak in the second quarter and to start drifting down in the third and more so in the fourth quarter, then we're okay. If inflation is above 7% all year, I would be quite concerned.
There are a few questions on here that are really quite outstanding, but I think would take an actual economics class to answer. So I'm going to have to skip a few of those and go to Bill on some others. Bill, can you speak about the amount of money supply impacting inflation? If you have already, and I apologize.
Yeah, no, I haven't. So back when I was in school and back when I was teaching college, we would, one of the sayings we got from Milton Friedman was that inflation is always and everywhere a monetary phenomenon. In other words, the rate of growth of the money supply determines the rate of inflation a year or two later. That used to be true until about 15 or 20 years ago, and it no longer holds anymore. However, we've had periods of huge increases in the money supply with no inflation as a result, or in fact, deflation. I think one thing that's happened since Uncle Milton Friedman was thinking about this is that the world's economies got a lot more interconnected and globalized, and so it's hard for one country to have inflation when it can have competition, price competition from businesses and labor all around the rest of the world. So we haven't, in the last decade and a half or 2 decades, we haven't seen this close connection between money supply growth and inflation. But people who remember that and look at the rate of growth of the money supply recently, which has been very high, that's one of the reasons people are worried about inflation. But that linkage seems to have weakened. It could come back, but so far it hasn't.
I think last question, there's a couple of others, Bill, that I'm going to let you address on an individual basis afterwards. Assuming no additional COVID strains negatively impact us, I'm assuming that's the U.S., will consumers continue to keep higher savings balances than in the past?
Well, one has to be really careful here because when you think about these sort of things, you think about this homogeneous single consumer and that everyone will act alike. And instead, consumers are, we've got 150 million households in the U.S. and people are different within households and different households behave differently. So having said all of that, on balance, though, I think that consumers might, at least for the next few years, remember what happened with COVID and the fact that it would be nice to have had more savings, and might hold slightly more savings than they were previously. But 3 or 4 years from now, I don't think that there'll be much of an effect there. And on the other question of what are people going to do with the excess savings they have now, I think they're going to be taking every opportunity to spend them down, which is why I don't think we get an inverted yield curve and a recession coming along, because consumer demand is still got tremendous tailwinds behind it from the buildup of excess savings of the last couple of years. And it's going to take a while for consumers to burn that through. And so they'll be able to afford stuff even with the higher prices for now because of the excess savings that they have. So Dave, I noticed there are a couple of other really interesting questions there that I'd like a chance to answer in the next couple of days. So if you can send me the list of questions.
I will.
And their names there, if there can be emails attached to them, or if I could send them to you and you send them along to the person. So
I should be able to I'll be able to get to that list, Bill. I'll get with you after the fact, and because I know there are a couple of really good ones here.
So I see them too quickly, and I couldn't answer them in a couple minutes. But I would be happy to. Hi, Brad. I'd be happy to send answers to some of these if I get the questions. It won't be right away. I got a couple of things going on, but I'll get to it in the next couple of days.
Bill, thank you so very much for being here today. It's been great as always. You made 90 minutes of economics talk seem like it was 89. No, it seemed like it was a lot shorter. So thank you very much. Everybody else, again, this will be available in about an hour on demand. It'll be available through the registration link. You also see this popping up on social media here in the next couple days as well. So take a look at it, share it with others if you like. If you have any requests for other topics that you'd like to see us cover in the future, other speakers that you'd like us to have, please let us know, and we'll be happy to get those as well. So for now, again, Bill, thank you. And everybody else, take care and stay safe out there. Bye-bye.
So long.